All right, everybody. Legendary investor Howard Marks and multi-billionaire Howard Marks just released a new letter, and it's not good. It's not good for his opinion on the stock market and what he thinks is going to happen with interest rates and inflation and a recession coming. So I want to cover this letter. He's a very respected investor. I want to cover how it might impact the stock market, and I want to cover what he just said is literally a change that's happening in the stock market that he's only seen once or twice in his 40 or 50 year investing career. So if you want to find this, it's a memo called Sea Change, and it is on Oaktree's website. If you just Google Oaktree blog, you'll find it. But this is a good summary. End of 40-year era of falling interest rates is crucial. Sea change for investors, from Howard Marks. Look how concerned he is. He is concerned. And so here's the biggest thing, right? This 40-year era of falling interest rates is over, forcing investors to throw out a playbook that worked well, particularly over the past decade or so, which is what Howard Marks just outlined in a memo to his clients and the world. So there's just a lot of unknown right now. This bottoming out of interest rates, he says, marks a sea change for investors, which isn't a term that he uses lightly. He's only seen 3 of these in more than half a century of investing. First one was in 1970 as investors adopted a risk versus return mindset when it comes to investing. Second sea change came after the Federal Reserve under Paul Volcker in the early 1980s hiked interest rates to eye-watering levels in the effort to wring out inflation, ushering in an era of falling interest rates that has since come to an end. The tailwind that has been provided by falling interest rates is hard to overstate. He says they're responsible for a significant chunk of all the money investors made over the last 4 decades. Wow, that's terrifying when you think about the future. More recently, the period between the end of the global financial crisis in 2009 and the onset of the COVID pandemic in 2020 was marked by ultra low interest rates. Again, low interest rates, low interest rates. That's the common theme here, and that theme is changing. For many investors, period from 2009 to 21, with the exception of a few months in 2020, saw optimism prevail and kept worries to a minimum, Mark said, while low inflation allowed central bankers to maintain easy monetary policies. Risk-free rate at 0, fear of loss absent, and people eager to make risky investments, it was a frustrating period for lenders and bargain hunters. Fed has since aggressively raised interest rates in response to the biggest inflation surge in 4 decades. Stocks have tumbled in 2020, S&P 500 down 15% year to date. Inflation and interest rates are likely to remain the main considerations for the investing environment over the next several years. While the base interest rate is more likely to average 2 to 4%, instead of 0 to 2%. The bottom line is that conditions at this moment are overwhelmingly different from and most less favorable than those seen in the aftermath of the financial crisis. We've gone from the low return world of 2009 to 21 to a full return world, and it may become more so in the near term. Investors can now potentially get solid returns from credit instruments, meaning they no longer have to rely as heavily on riskier investments to achieve their overall return targets. That means much better prospects for lenders and bargain hunters. Importantly, if you grant that the environment is and may continue to be very different from what it was over the last 13 years and most of the last 40 years, should follow that the investment strategies that worked best over those periods may not be the ones that outperform in the years ahead. Okay, and here's a little chart that Marks has in this memo that talks about the differences between 2009 to 21 and then today. So the Fed was highly stimulative versus tightening today. Inflation was dormant, 40-year high today. Economic outlook was positive. A recession is likely today. Likelihood of distress was minimal. It's rising. Mood was optimistic. Now it's guarded. Buyers were eager, now they're hesitant, holders complacent, today they're uncertain. And so basically all of this stuff just shows like the market's really scared today. Now the thing is you would think that when everyone's scared, this would be the time to invest, right? But the problem is that if we look at the PE ratio, the average PE ratio, this is just of the S&P 500, over the last 20 years, you can see the normal PE ratio is 19.6. And we're sitting at a blended price earnings ratio of right about 19 right now. So the market isn't extremely discounted to reflect all of that fear in the bad stuff that's really expected to happen. And so you would think by all of those bad things in the chart that the market was like way cheap. Well, it did get down, much cheaper, down to a PE of 17. but it's since rallied back a little bit, and who knows, it might drop again, right? After 2009, it traded down to a PE of 15. And so if it did that, we're talking about a 20 to 25% drop from levels today if it were to go down to a PE as low as in 2009. Even in 2012 at one point, it was trading down at a PE of 15. And so the question is, like, what do we make of this and what do we do? And I think first and foremost, for most people, it means to control our spending right now and cut back on things that we don't need. Get smarter with our money. Try to save more of our money versus spend it. Try to do the best job we can at our job so we don't lose the most important thing to most of our livelihoods, which is our income. If we can control that, we might get to a point where we can't control that and there's just widespread job losses. Hopefully that doesn't happen. But those are the types of things we should be doing right now. I'm not selling out of all my stocks and trying to time the market. That's not what I'm trying to do. But I'm certainly not taking margin loans and risk and doing crazy YOLO trades and just being ridiculous, right? Like, let's manage our finances, let's manage our health, let's manage our energy, let's do the best we can at our job, and let's invest for the long term. Here's what I want to leave you with after all of this negativity, right? This is what $100 invested in the S&P 500 from 1926 to, I believe, today, or this week's prices. $100 in 1926 has turned into $1 million over that 100-year period, basically. So you can see S&P 500 started at 1265 back in 1926. The ending value was 3,770. That is a 29,000% change in price for about 6% per year. If you include dividends, that is a 1 million percent change. That's insane. 29,000 versus 1 million percent if you add dividends, and then just 4% a year. So including dividends, you're at 10% per year. If you adjust that for inflation, you're up to 6.88% per year. So that's how much you've made inflation adjusted for a gain of 62,000%. And so nominal, meaning not inflation adjusted, that $100 is worth $1 million. If you just added 100, never did anything else. But with adjusting for inflation, that $100 is still worth $62,685. He talked about how great the last, decade or so has been, or 2 decades has been, right? But let's just look at 50 years from 1926 to 1976, right? $100 still turns into $8,534. And we'll just look at the percentages, right? Not including dividends, 4% per year. If you include dividends, 9% per year. And so your final amount nominal, again, not just for inflation, that $100 turned into $8,534 over 50 years. Versus inflation adjusted, your $100 turned into $2,654 over 50 years. Now imagine if you were investing every single month and $100 a month, $500 a month, whatever, you're going to do even better than that. And so the great news is if your timeline is long enough and you're a long-term investor, things tend to work out, right? Who knows what's going to happen in the short term? I don't know, but I know that I don't want to miss the next 10, 15, and 20 years investing in the stock market. And if I try to macro time and time the market, then I will miss it because I'll never feel comfortable buying. Okay, so that's what I'm going to do. I'm just going to continue sticking to the plan and being a long-term investor. But I know it's worrying right now, and I know it's scary, and there's a lot of fear out there. So just do me a favor, let me know in the comments just how you're feeling. Are you feeling a little worried? Are you feeling good? Are you feeling like you're getting to make some good purchases for long-term investments? And if you appreciate this content, you can support me for free by liking the video and subscribing to the channel. Have a great day.